Well, hello everyone. I hope you and your families are staying safe and healthy, and I will wish you a happy rainy Tuesday. Yes, I do mean happy rainy Tuesday. I probably, like a lot of you, have a pandemic-inspired garden and landscape that was badly in need of some sustenance to prepare it for growth for this long, hot summer that I hope we have ahead. And I would say we're all kind of a bit like my pandemic landscape. We need to pause, take care of ourselves, probably more often than we do, to be the best versions of who we can be, which is why the Fairport and the Luma team has spent 2020 with an inspiration to look out for you and your families and your overall well-being, not just your financial well-being. We started the year with our friend Jill Miller telling us how to nourish our bodies for better brain health. We then heard Dr. Kaysen talk to us about consuming half of our body weight in water so that we can reach an attainable and commendable goal of drinking way more water than I used to. We even sprinkled in some fitness meetups along the way, which inspired me to reinvigorate my yoga practice. Yay. And although those are pretty tough acts to follow, I've dragged my colleague Pete DeVito here with me, and we hope to provide a little nourishment for your mind. We're bringing you the first presentation geared towards optimizing your financial wellness decision-making. Our optimization program is going to take you through the 4 life stages of wealth, and we're going to try to provide little tools and tidbits along the way for optimizing both income tax and cash flow decision making to get you just a little bit closer to your goals. So with that, I will ask for us to advance to the next slide, and we have a little quote for you. Oh, see, I already missed his slide advance. Hey, technology issues. Move on to the next. Good old Ben Franklin giving us a very heavy quote: "In this world, nothing can be said to be certain except death and taxes." Quite heavy, but although nothing sounds fun about death or taxes, I can assure you that if anyone can make taxes fun, it's Pete and me. So stick with us. We will have a little bit of fun today. So next slide, please. Let's talk for a second about your goals. We are not going to ask you yet to pipe in and share your goals with us, but it's really a critical piece of optimizing your wealth. The goals are really what motivate us in all aspects of our wellness, whether it be the health, the weight loss, the fitness, or the financial. It's truly the ultimate motivator and the compass that points us in the direction that we want to be. So again, we're not going to ask you to share your goals with us today, but just take a second to think about what are the long and short-term goals that are on your mind and that are driving your decision-making in this moment in time. All right, so now we're going to start that fun. For the fun I've been promising, what could be more fun than a quiz? Yes, I am a geek. I heard a collective yawn, but don't be scared. We are going to kick off today with a poll asking you a few questions from an IRS quiz of all things, and you don't need to know taxes. This is just some fun trivia. So get ready and gear up. If you answer all 3 questions right, you are going to get some Fairport bucks. And along the way, as you collect the Fairport bucks, you'll be part of a little contest where we will find a winner at the end of who has done some of the most beneficial things to optimize their wealth. So with that, Annika, I think we have a poll. Can we get people started with our IRS tax quiz? So I don't know that I have to read it to you, but I will. Which ancient civilization revered the tax professional as most notable person in the society? Dang, I should have lived there. I'll give you a few minutes here and we will give you the answer. All right. So hopefully we've got a good number of answers. And note that A, Greece, knows how cool Pete and I are. So we just need to make a visit, I guess. All right, a lot of you did pretty well on that, but you know what? I would have picked Rome too. All right, next, folks, we've got our next question. Or maybe we don't. There it is. How much do you think the tax on a gold watch was during the Civil War? All right, I think you've had a little bit of time to answer there, so I will give you the answer. It is C, $1.50. Ooh, wow, you guys are good. That is not what I answered the first time I took this quiz. I give you all kinds of credit. All right. And now for our last question. Over 118 million individual income tax returns that the IRS examined in 2013 resulted in a refund to taxpayers. What was the average refund? Okay, I think you guys have had plenty of time to answer. Again, this time the answer was C, 2,725. So you were close. All right, so keep note of that, everybody, and keep track of your Luma bucks. If you got all three of those answers correct, you earned 100,000 Fairport Luma bucks towards the contest that we will reveal the winner of later. All right, so next slide, please. So today we're going to talk about essentially the ways to optimize cash flow and tax decision making in 4 stages of life cycle. And some of you might look at this and say, I'm not just starting out, well, because I know I'm not. I'm past my peak earning years. I might still be in mine. But that being said, still, even if you're past some of these stages of the life cycle, I know that you have children, grandchildren, friends, family members that are in those life cycles. And to the extent that you can actually learn some of these things, take them back to the friends and family and share with them, that'd be, absolutely helpful and I think greatly appreciated. So stay tuned. It's all going to be of interest to you. Next slide, please. And we're off to Pete.
Well, thank you, Emily, and thank you all again for joining us today. I'm sure everyone's getting a little tired of webinars, but like they say, this is becoming our new normal. I even shaved my beard for this. I must say growing one was a little more work than I thought, and it didn't help that it was coming in a little too much salt, not enough peppered, but I can finally check it off my bucket list. Let's get started, which is a good segue into our first slide. That it is never too soon to start saving. This is especially true for retirement plans because they have the extra benefit of tax deferral, meaning your assets are growing tax-free every year. To give you an example, we have 2 investors who have both saved for retirement. Investor 1 starts at age 25 and contributes $5,000 a year for 10 years. Investor 2 starts at age 35 and contributes $5,000 a year for 30 years. Who has amassed more at age 65? Well, as you can see by the chart, Investor 1, which is the top line, has $175,000 more, even though they contributed $100,000 less because of starting early and the power of compounding. Another way to illustrate this is the rule of 72. This is a simple concept. So if you don't take anything away from today's webinar, try to at least remember this. You start with 72 and you divide by an interest rate to determine how many years it takes money to double. At 6%, money doubles every 12 years. At 8%, every 9 years. To give you another quick example, if you accumulated $500,000 at age 45 and it grew at 6%, you would double to $1 million at age 57 and $2 million at age 69. So the earlier you start, the better. Okay, let's go to our next polling question. There we go. Did you begin investing early in a retirement and/or taxable account? The answers from here on out are going to be yes and no, so it should be pretty simple to check in. Okay, maybe a few more seconds and we'll close the poll. Wow.
Good job, folks.
Everyone started early. That's great. So
That.
if you answered yes, which almost everyone did, give yourself 175,000 Fairport bucks. Okay, I think next slide.
All right, so speaking of savings, let's talk for a little bit about company retirement plans. Just a few things to say here. You know, especially when you're young, it's tough to balance all the bills you have to pay and all the savings you want to accomplish. But I would say that if you're still in a position where you're trying to strike that balance, if you can't contribute the max to your 401k, at a minimum, do the best you can to contribute enough to fully benefit from the company match. Companies are very transparent about their matches, and again, you're leaving money on the table that your employer will give you if you don't at least contribute enough to benefit from that. Another discipline I love to employ, due to the whole out of sight, out of mind theory of money, and I actually was talking to a younger client about this last week, it's have the discipline that as you're getting raises, if you're not maxed out on your retirement plan, just take that money you didn't have the day before and put it towards your 401k. It's a great way in those younger years to maintain that discipline of getting yourself up to the max. And again, if it's money you didn't have the day before, you're never going to miss it. So divert it into your retirement plan. I think the one other thing I will say here, and this is a big one, and I think for people across the ages, is that big question I get asked a lot, to Roth or not to Roth? That is the question. And I do think when you're in the low tax brackets, it's pretty much a slam dunk. It's kind of like, of course I will, you know, save money after tax that will grow tax-free for my really, really long life I have ahead. I get the question though often from people who are in higher tax brackets and a bit older, and back in the old days when we all started, this wasn't even an option. So we didn't get the benefit of starting this as early as some others. I personally do still contribute half to each. And for me, it's because a part of my goals is having choices in the future. And when you're contributing to both a Roth and a traditional retirement account, you have choices because the monies are taxed differently in retirement, which we'll talk about later. So just because you're in a higher bracket doesn't mean you shouldn't contribute to a Roth. It really, again, it goes back to those goals and what's important to you. And if choices are important and you don't have any Roth dollars, you may still want to put a portion of your contributions into that plan. So next slide, please.
Did you know that currently 25% of working Americans have no retirement savings, including 13% of workers age 60 and older? And not surprisingly, 2/3 of working millennials have nothing saved for retirement. Well, traditional IRAs and Roth IRAs, similar to 401k plans, are great vehicles to help you start saving. Anyone can contribute, even kids. All you need is earned income. With a traditional IRA, you get a tax deduction when you contribute, and you pay tax when you pull it out. It's just the opposite for a Roth IRA. There's no tax deduction for contributions. However, there's no tax due on all future distributions. Plus, which we'll discuss later, there's no required minimum distributions when you turn age 72. Now for 2020, the contribution limits, which did not change from 2019, are $6,000 for those under age 50 and $7,000 for the catch up for those over age 50. These amounts generally get indexed for inflation, but there are income restrictions to be able to make annual individual Roth IRA contributions. For traditional IRAs, there is no income limit on tax deductibility unless you're covered under an employer qualified plan. However, even if you are limited on the tax deductibility, you can still make what's called a non-deductible IRA contribution. Your money will continue to grow tax deferred, and when you pull it out, you'll have basis in that year's contribution. Okay, next slide. All right, this next slide is about 529 college savings plans. And it could also be relevant in your peak earning years if you got a late jump on your child's education savings, or in your legacy planning years if you wanted to do something for your grandchildren. You know, grandparents always want to help out with college, but I think if they're feeling overly generous, braces are not a bad option too.
I take that.
Didn't work for me though. College 529 plans, like retirement plans, are great ways to save. Earnings accumulate tax-free. Distributions are tax-free if used for qualified education expenses, which include tuition, room and board, books, and yes, even laptops. This is how my oldest son swindled me into buying him a new MacBook Pro. He even tried to sound all knowledgeable by saying, you know, Dad, you can reimburse yourself for a laptop from a 592 plan. And he's my business major. Well, contributions to 529 plans are technically taxable gifts, but as long as the annual contributions are less than the annual gift exclusion, which is $15,000 for single and $30,000 for joint, there are no gift tax implications. Furthermore, the law allows you to front load 5 years of contributions. Even the IRS is catching on that kids don't graduate in 4 years anymore. And this can be especially beneficial for a young child. You could contribute $75,000 or $150,000 if joint in year one, and as if you made a gift over 5 years. Now, there are some changes that took effect in 2018. Each year, up to $10,000 can now be used to cover private school tuition for grades K through 12. And if you're an Ohio resident and invested in the College Advantage Plan, your state income tax deduction doubled from $2,000 to $4,000 per beneficiary. Any excess contributions continue to carry over indefinitely. And other new changes for 2020 as part of the Secure Act allow lifetime withdrawals up to $10,000 per beneficiary to repay student loans. And registered apprenticeship programs now qualify. So today, 529 plans are not just for tuition anymore. Okay, next slide.
All right, that's me. So we are going to talk about HSAs and FSAs, and they live in this rarefied air world where they are actually triple tax protected. Very unique amongst savings opportunities. So if you haven't taken advantage of, do. And to Pete's earlier point, this is something that you can take advantage of in your early savings years, in your peak earning years, and all the way with an HSA until age 65. You can keep going until then. So take advantage if you can. One of the keys with an HSA is you do have to be a part of a high deductible health plan, but you know, as we all know, those are becoming more and more common these days. Pretty much anything you buy on the open market is a high deductible, and most companies are at least offering one, if not, that is their only choice. The beauty of HSAs and FSAs is you contribute either pre-tax or you contribute and get a tax deduction. You grow those plans tax-free, and as long as you use them for qualified expenses, they are distributed tax-free as well. Thus, this holy grail of triple tax protection. Contribution limits for HSAs this year are $7,100 for a family and $3,550 for an individual, and they also provide for a $1,000 catch-up, much like you hear with retirement plans. With HSAs, they are not use it or lose it. You can save and accumulate and continue to grow and build that balance. You can invest HSAs, And by the time you reach retirement, if you've saved those rather than spend them on day-to-day medical expenses, you have those available for future expenses, and you've probably gotten a lot of growth associated with them. They are really, again, a great vehicle to use if you have the access to them. FSAs are a little different in that they are use it or lose it. So to Pete's earlier point, I'm doing a lot of braces at my house, and I have a limited purpose FSA that I can use for braces and glasses. We were also talking about contacts earlier, Pete and I. So you can use those, but you have to use up the dollars every year or you lose them. But either way, a great way to save and set aside, not just in your early in your early years, but also all the way through arguably retirement years. Next slide, please. All right, so, I think now might be a good time for us to pause and just see if anybody has any questions. We covered our first life cycle, the early earning years, and I'm wondering if there's anybody out there that might want to pick Pete's and my brain about anything we've talked about or any questions you have.
And we'll still have time at the end of the webinar to answer questions if you don't have any right now.
We will. So Annika, let us know if we have any questions, and if not, we'll move on to this topic I super geek out about, executive compensation.
We don't have any at the moment, so you are free to continue.
All right, beautiful. Let's move on to the peak earning years, and what better way to give a boost to your earning years than making good decisions about your compensation. So with the next slide, we will chat a little bit about that. Now, I will warn you, I do a whole program on negotiating your compensation, and there's no way I can cover all that or you'll be here all day. So I'm trying to just synthesize this into one slide. I thought I would share just 3 takeaways from that program that we do. And number one, I would say it's all a matter of leverage. As weird as it sounds, negotiate your way out on your way in because your leverage may never be better. So that really goes to just being thoughtful at all stages of your career. And as you're on a way into a company, you love them and they love you, and you may want to just jump, but make sure that as you're walking into that next opportunity that you're really being thoughtful about the compensation package and whether or not it meets your needs. So negotiate your way out on the way in is the first thing I would say. The next thing I would say is never underestimate the power and the value of non-cash type benefits. Whether it is club dues or society dues, reimbursed expenses, tuition reimbursement. These are things that often fall off of people's radar, but they are really add a powerful punch to a compensation package. So you can't just think salary and bonus. You've got to keep those non-cash type benefits in mind. We talked about a retirement plan match earlier. Some companies obviously way more robust than others. Don't forget to think about that as you're negotiating your compensation. The third takeaway that I would say would simply be ask for what you deserve and don't be afraid to ask. Just a little quick story for you about someone that I know, very capable, financially minded individual, very advanced in his career, was getting ready to negotiate into a new position at a new company, but was leaving a position where he had been granted restricted shares, and those restricted shares were getting ready to vest in the next 6 to 9 months. And he said, well, I really want this job, and I don't think the new company is gonna give me restricted shares that will vest right away. So I think I'm gonna have to just take one for the team. And I said, it can't hurt to ask. And there was a little trepidation about, will I look greedy? But, you can wordsmith things in a way that you're trying to make sure that you're looking out for the best interest of yourself and the company. And restricted shares are a motivator for financial success for both you and the company. So fast forward, he did have that discussion. They did actually adjust that particular grant to make sure that if he left for reasons that were not his own choice, that he would end up getting that grant. And indeed, that happened. So had he not negotiated, he would have lost about $500,000. Now, does it always mean a difference of $500,000 for all of us? No, for him it did. But all of those things add up. And even if it's $5,000 or $10,000, it's really meaningful, and particularly when it's early in your career. So that brings us to our next drum roll, Fairport Bucks opportunity. We are going to ask you a polling question, and you are going to answer, and then I'm going to tell you a story about why it's important to negotiate your comp. So, Annika, can you share the polling question? So I'll give you a few minutes to answer. I think this should be a pretty easy answer. I'll go ahead and rat myself out and say I did not negotiate my starting salary when I was offered a position at one of the big, at the time, 6 accounting firms. Dang it, boy, did I leave some opportunity on the table. So go ahead and show us the results, Annika. And I am going to tell you all that if you did negotiate your salary, the 32% of you, kudos, kudos, kudos. I live in the other 68% of you. This is going to be hard to believe, but if you had advocated for yourself and were able to negotiate $5,000 more in base salary at age 29, it would have resulted in a $300,000 increase in your wealth over the course of your career, assuming 2.5% annual raises and retirement at age 65. Yes, I did say 300,000. I literally ran those numbers 5 times. Really? Is it that much? It is. So if you're amongst the 32% rock stars, please give yourself $300,000 of Fairport bucks.
Okay, thanks, Emily. These next few slides, we're going to dissect the 2018 tax law that we are currently in. So income tax planning is probably most critical in your peak earning years, because this is when you're likely to make your most money and need to maneuver around the tax brackets. This chart reflects a 100-year history of income and capital gain taxes. It's one of our favorites. The top line represents ordinary income rates, and the bottom line capital gain rates. And ordinary income includes things like wages, self-employed income, Social Security, pensions, and IRA distributions, while capital gains apply to qualified dividends and most of your investment sales. As you can see on the far right hand, we are still near historic lows in tax rates. Okay, this next chart is going to be an extension of the previous slide, but it's going to take a closer look at the rate changes in the past 20 years. It's not meant to be partisan, but you can probably see a pattern of tax rates going up and down based on which administration was in office. Now, under the current tax law, ordinary rates are now split into 7 brackets, ranging from 10 to 37%, while capital gains have 3 brackets of 0, 15, and 20%. And just to complicate things further, the top rates include the Affordable Health Care Act surtaxes, which is 0.9% on earned income and 3.8% on dividend and capital gains, which is why the actual top income rate noted is 37.9%, and the top capital gain rate ends up being 23.8%. Okay. The 2018 tax filing season was the first year under the recent tax reform changes. About 2/3 of taxpayers actually received tax cuts under the new law, and only about 6% paid more in taxes. So stated another way, you could say 94% either paid the same or less in taxes on their 2018 returns. However, a Gallup poll last year found that just 14% of Americans thought their taxes went down. So perception does matter. Let's take a look at some of the changes. On average, every tax bracket dropped about 3%. But the big adjustment was the elimination of personal exemptions and the increase in the standard deduction, which is now $12,000 for single and $24,000 for joint filers. 87% of taxpayers took the standard deduction in 2018, and it's likely to be a similar amount for 2019. This was up from 69% in 2017 under the old rules. Now, to make up for the loss in personal exemptions, the child tax credit doubled from $1,000 to $2,000 for children under 17, but does phase out for joint filers with incomes greater than $400,000. And under the new law, alternative minimum tax, or AMT, as we fondly know it, is still around, but the exemption was substantially increased from $100,000 to $1 million, to a big sigh of relief from everyone. I used to say if you asked 10 CPAs to explain AMT, you'd get 11 different answers. Nobody could properly explain it, but it affected 80% of taxpayers making between $250,000 and $500,000. Now, for every 62 taxpayers that were affected by AMT, there's projected to only be one. Okay, next slide. There was also some big changes to itemized deduction. The one that properly affected most of you was the capping of state, local, and real estate taxes at $10,000. Previously, there was no limit for regular tax purposes, but many of you likely did not get a full deduction due to AMT. So the net impact of this change was probably not as bad as originally feared. The mortgage debt limit decreased from $1 million to $715,000 for new loans to be able to fully deduct the interest. And no longer can you deduct home equity interest unless you specifically use it to improve your house. Medical deductions survive, but Congress keeps changing their mind whether it needs to exceed 10% or 7.5% of your adjusted gross income. Now, at least for 2019 and 20, it is back to the 7.5% hurdle. Some other expenses have been eliminated too, most notably investment advisor fees. There were new rules regarding alimony, and it could be good or bad depending on where you fall. If you're the payer, not so good because alimony paid is no longer deductible. If you are the payee, very good because you don't have to pick it up as income. And there is also a new 20% qualified business income deduction that would take longer to explain than AMT. But just remember, if you're self-employed or have pass-through K-1 income, you may be able to take this deduction. And finally, let's say with the new tax reform laws, we've lost some of the tools in our toolbox. But the one item that could still be an effective tax strategy is charitable gifting. Many tax planners are advocating a bunching type strategy whereby you accelerate charitable deductions to itemize in 1 year and then take the standard deduction in the next. This way you get your biggest bang for your deduction buck. And for 2020, as part of the CARES Act, there is a new $300 above the line cash charitable deduction.
All right, that's me. So I think we've all heard diversify, 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 and we've also heard that maybe some years that doesn't always work, but we still believe in diversification, and there's different ways to diversify besides just different asset classes or different stock sectors. I would also argue it's really important to do account type diversification and tax type diversification. So similar to diversification of asset classes, it helps you to kind of reduce the risk and optimize your wealth. We talked about it a little bit earlier when we hit on Roths versus traditional IRAs and 401ks. Those are actually two different kinds of money. We have a colleague, Ken Coleman, who likes to talk in buckets. So I'm going to talk in buckets for the moment. And there's essentially 3 different buckets of taxable type money or money taxation that you should consider when you're getting ready for retirement. And in an ideal world, you've kind of balanced out your money amongst those 3 buckets. So you've got your Roth bucket, which is that tax-free bucket. And to Pete's earlier point, you don't have to take required minimum distributions from that. There is the tax-deferred bucket, which is your traditional 401ks and your traditional IRAs. And those, while they grow tax deferred, when you take the money out and get it distributed, they get taxed. And then there's the third kind. It's like those traditional brokerage accounts and investment accounts that are what we call after-tax or taxable dollars. They're invested, and typically the predominance of their growth is capital appreciation, which is taxed at capital gains rates. And in some of what Pete was talking about earlier, he shared that the max capital gains rate is 20%, and the capital gains rate for the average population is 15%, or even lower for some lower income populations. So ultimately, you can have money in all of those three buckets, and then in retirement, you really can do a lot of great tax planning because you've built choices for yourself by doing this tax diversification. And we can talk a little bit more about that later, but for now, let's move on to the next slide. All right, we are moving into retirement. We will again pause here. We've peppered you with some ideas for maximizing in your peak earning years. Are there any questions at this stage in the game in regard to the first two sections?
Yes, I do have a couple questions. Before I read them, I just want to remind everyone that you are muted, but if you do have questions, you just need to type them in the questions box on the bottom right. And I will read your questions aloud for Emily and Pete. All right, our first question, Sarah Bartlett, in regards to the HSA, FSA. She said, I thought that she understood some employers do not allow them to roll over. Are you saying that we can have independent HSAs outside of our employers?
I'll take that, Pete, and then you can add anything that you'd like to add. Yes, Sarah, you can actually have an HSA that you establish with many institutions will allow you to establish those. And you can indeed roll HSA dollars from one employer to another. Now, keep in mind, that's a big difference between an HSA and an FSA. FSAs cannot be rolled. But with those HSAs, as a matter of fact, even individuals right now that I know that aren't working, but that are participating in a high deductible plan, if they are under age 65, they can open up an HSA at, for example, any banks. Oftentimes brokers will allow you to establish HSAs. And then there's even some independent HSA plans or administrators that administer plans that you can start and fund. So yes, you may.
And Em, I would just add that HSAs are very similar to IRAs in the nature that it is portable, and you can always roll it over into an individual HSA, just like you can an IRA. So one of the nice things about it is when you do leave a job, whether you go to another employer or not, you can continue to roll that HSA into your own.
Thanks for the question.
All right, and then another one. With an HSA, can you continue to leave the money in the account even if you are not in a high deductible health plan for a period of a few years? And that was from Catherine Hobson.
I will answer that question as best I know how, and Pete, pipe in and correct me if you think I'm wrong. The only limitation is as it relates to contributions. So if you are not in a high deductible plan currently, you are not allowed to contribute. But that being said, if you were previously in an HSA eligible plan and you contributed to an HSA and you accumulated those funds over a period of years, you can leave those funds in that HSA to continue to grow. And there is no limitation to that if you go off and get a job where you are no longer in an HSA eligible plan. You just can't keep the contributions going during that period. Anything you want to add there, Pete, or correct?
That is exactly correct. So there is no cap on the value of an HSA. It can grow to whatever it grows. It's just the contributions that are limited, and you can't continue to contribute past age 65. But a great planning strategy is, and we have some clients who got into HSAs way back when it started, who contributed the maximum every year. and have accumulated a lot of assets in there that when they turn 65, you can use it to pay Medicare premiums. So it's another beneficial strategy in that regard to let those assets continue to grow.
You have any more questions for us, Annika?
Yes, I believe we have one more that just came through.
All right.
All right, from Ron Arndt.
Hi, Dr. Arndt.
He says, for later, as I am concerned about what is being taught in colleges today, I am uninterested in funding college education for my grandkids. However, I believe I heard Pete explain that 529 plans now allow trade school programs to be eligible. Will you please explain in more detail?
Well, it is new for this year, and it was part of the Secure Act that went into effect in January. And one of the things, to Dr. Arndt's point, is, college isn't for everyone, and the cost of the tuition is getting outrageous, that more kids need to have options. And I think as a way to grow trade school and apprenticeship programs, the 529 world has started to get behind it, and it can be used the same way. So yes, that is something new that does go into effect this year. It is all I know under the new law is a registered apprenticeship program. So you'd have to check with each trade what your child or grandchild be interested to make sure it's approved, but it is part of the new 529 plan rules.
And always along the way, accredited associate programs have been covered as well. So there is a key to accreditations for some coverage, but that's been allowed for many years. Well, thank you all for the questions. And so, Annika, I think we're ready to move on to retirement. We've all worked really hard, grown our wealth, and now we're ready to hopefully coast on Easy Street. And I think Pete's going to start to take us there.
Okay, a common theme we hear from clients all the time when they get ready to retire is that they want to simplify their life. And one of the biggest things we can do as advisors is to consolidate accounts for them. And those getting ready to retire today may have 2 or 3 former 401ks floating around. The good news is these can all be rolled over into one IRA and maintain the same tax deferred status. Now, as I was just mentioning a minute ago, the biggest change in the retirement world was the Secure Act, which had a lot of provisions that went into effect on January 1st, 2020. It favorably removes age restrictions on IRA contributions. Under the old rules, you could only contribute to IRAs until age 70.5. Now there's no age limits as long as you have earned income. The other positive is the required minimum distribution, or RMD age, has increased from 70.5 to 72. But the most notable provision involves inherited IRAs. Under the current rules, surviving spouse can roll over a deceased spouse IRA as their own. That did not change. However, what did change, non-spouses like children who inherit IRAs are now required to take out distributions within 10 years. You might ask, why does that matter? Well, a child inherits an IRA at age 40 could have a 50-year life expectancy and be able to stretch out that IRA for a much longer period and pay much less in taxes. Now, under the new rules, the entire account has to be exhausted by the end of the 10th year. There are some exceptions for beneficiaries, like being disabled, chronically ill, a minor child, or someone less than 10 years younger than the owner. And one potential strategy is to split beneficiaries. Assuming the surviving spouse has enough resources to live on without needing the full IRA, you could add children. Suppose a husband has a $2 million IRA, names his wife and son each 50% beneficiaries. The son would have a 10-year period on the inherited half from his father, and then when his mother passes, would have a 10-year period on the other half from her. This could substantially increase the distribution period and therefore reduce the tax bill. Now might also be an opportune time to convert to a Roth IRA. This popular strategy is, again, to pay tax now so you don't have to pay tax later. Converting a portion while values are somewhat depressed can further result in significant tax savings over time, especially if rates were to go up in the future. Fidelity Investments noted that Roth IRA conversion surged 76% in the first quarter this year from a year ago.
Yeah.
And another strategy that will likely gain traction, especially for those who have charitable planning as part of their estate plan, is to name a charitable remainder trust as an IRA beneficiary. In the trust, you could name your child as the income beneficiary to be able to stretch again those distributions greater than 10 years. At the death of the child or the end of a maximum 20-year term, the principal would then pass to the named charity. And finally, it is important that you review your trust documents, especially if it is named as a beneficiary to your IRA. What you don't want to have happen is to not do nothing for the first 9 years and then have it all taxed in year 10 upon distribution.
All right, this is me, and thank you, Pete, for teeing me up on withdrawal strategy. You know, you might actually be surprised to hear that early retirement years can be some of the most opportune times and years to do tax planning. And the reason for that is you've got this gap between your earnings years, presumably, and RMDs kicking in at age 72. And so you can play the tax brackets. And so to Pete's earlier point, you know, some strategies that you can employ during those early retirement years is potentially doing some Roth conversions, particularly if you find yourself unbalanced in those buckets and your traditional IRA bucket is a lot heavier than everything else, to be able to start to do some of those conversions in lower tax bracket years in anticipation of wanting some choices in later retirement. It's a great thing to do. So keep that in mind. Just because you're in retirement doesn't mean it's too late to do great tax planning. It's something else to keep in mind though is, and this is, you know, we all have to admit our mistakes. And I learned a lesson early in my career with a lovely client who remained a client until she passed. And now I work with her kids, but she taught me a real lesson about IRMA. The dreaded IRMA. I don't know if any of you know what this is, but it bears repeating because I'd like to share all of my lessons with you. When you create taxable income in your retirement years, 65 and above, while you're on Medicare, you do run the risk of bumping yourself not only into a higher tax bracket, and of course I knew that, but you also run the risk of bumping yourself into the next IRMA bracket. And those are the brackets that they use to determine the cost of your Medicare insurance. Wait, what? I thought Medicare insurance cost was the same for everybody. Well, no, actually it's not. At its low range, it's around $136 a month, and I'm rounding. And at its high end, if you kick yourself into higher and higher IRMA brackets, you could be paying as much as $461 a month. That is like a $300 difference. Now, I didn't kick her that far up, but I did kick her into the next IRMA bracket. And boy, did she call me when she got her summary of benefits for Social Security. And we both learned a lesson, and she still loved me. But, you know, keep in mind that that's something that you want to consider as you're doing your tax planning, is trying to also play those Medicare brackets. So, you know, being aware with your withdrawal strategy, trying to opportunize any tax savings that you can, but also making sure you don't cost yourself more for your medical. It is really important. Next slide, please.
Okay. You know, two of the biggest misnomers about retirement are that you'll be in a lower tax bracket and you will spend less. You know, chances are if you've done a good job saving, and more importantly, we've done a good job managing your assets, you could be in a similar tax bracket because you're in essence replacing your salary with retirement income. And secondly, your costs don't always increase as much in retirement as you expect. You typically just substitute expenses a lot of the time. Required minimum distributions, or RMDs, which we talked about, are an important part of your retirement planning. RMDs are based on an actuarial life expectancy factor that increases each year. So the older you get, the more money you actually have to withdraw from your retirement account, even if your assets don't grow. See, the IRS does not want you to, or excuse me, the IRS does not want you to die with your money. They would rather tax it instead. And one way to counter this measure is a qualified charitable distribution. This works particularly well if you do not need the income and you're charitably inclined. Requirements are you must be at least 70 and a half, the amount is less than $100,000, and it goes straight to a qualified charity. You might ask, why not just take a charitable deduction? Well, rule of thumb is it's always better to get an above the line deduction where you don't have to worry about getting over a standard deduction hurdle. And by donating some or all of your RMD, you reduce your taxable income, which could mean less of your Social Security is taxed and a potential reduction in Medicare payments, as Emily just explained, which is something all seniors can get excited about. Also, if you're a resident of a state like Ohio that provides no income tax break for charitable contributions, that can be another 5% savings. Now, the other new tax law to pass in the last 6 months is the CARES Act, and it has also had an impact on retirement planning. Most notably, it has suspended all RMDs for the 2020 tax year. Congress can sometimes show it has a heart. The RMD rule applies to IRAs, inherited IRAs, and qualified plans such as 401k and 403bs, but not to defined benefit plans. Now, what if you already took your RMD this year? If you took it out after February 1st, you still have time because the normal 60-day rollover rule has been extended until July 15th, 2020. So you can recontribute the original amount back into your IRA without it being taxable, but you better hurry because the clock is ticking. And if you already took your RMD from an inherited IRA, you cannot recontribute the distribution this year. And just remember, you can only do this rollover strategy once every 12 months.
All right, Social Security. I'm not going to spend a lot of time here because back in 2019, for any retirees that were not yet 66, the Social Security Administration really eliminated a lot of the, and I won't even call them loopholes, but they were known ways that you could maximize your Social Security benefits, particularly in relationships where there were spousal benefits. There were certain ways to optimize. Most of those, all of those, gone. Really now, the only pivotal decision making is, do I take it at earliest possible age 62 when it is available, or do I wait until my full retirement age, which now is in the 66 age range, or do I wait until the maximized age where the benefits have continued to grow, and that would be age 70. And by the way, never take it after age 70 because the benefit doesn't continue to grow after age 70. What I will say is I think cash flow considerations just have to come into play first. You know, in most cases, it makes sense to wait until full retirement age or age 70. But really, I would consider cash flow when making that decision as to whether I take it at full retirement age or I wait till age 70. And, you know, certainly there's lots of Social Security optimizers and calculators that if you're considering this, talk to your advisor and they can help you to assess it, to look at different break-even points. How long do you have to live to benefit from waiting until age 70? So all kinds of ways to look at this, but waiting until 70 does increase your monthly benefit by like 76% and your lifetime to age 89 by 24%. So it can be beneficial, but it's not the right answer for everyone. So assess based on your actual situation. All right, moving on to the next slide. And so now we're done. We've retired. We've lived happily through our retirement years, and we are ready to plan a legacy. But before we do, just wanted to check in and see if anyone has any questions for Pete and me on that retirement section.
Nothing yet, but do you want to
All
leave
right.
a minute or
Well, hold on to any thoughts that you might have, and we'll answer more questions at the end, but let's move on to planning your legacy. Annika, we can go to the next slide.
Okay, this is our last section about our legacy planning years, and a lot of it involves estate planning when we get to that age. So not only did the individual tax landscape change in 2018, but also the estate tax universe. The new law doubled the estate exemption from $5.5 million to $11.2 million in 2018, and it will continue to get indexed for inflation each year. In 2020, the estate exemption is $11.58 million. This means for a joint couple, they would now need to have assets greater than $23 million in order to have an estate tax liability. There are some other important features that continue to be the same in the new law. Step up in basis is retained. Assets will continue to get stepped up to their fair market value at the decedent's death. There was a concern that if the exemption was increased that much, these step-up rules would go away. And why is that a big deal? For beneficiaries, it is huge, because when you sell inherited property, you could virtually have no capital gains at the step-up fair market value versus a potentially large capital gain at carryover cost basis for an asset that may have been held for a very long time. Portability was also retained, which means the surviving spouse can use the unused estate exemption of the deceased spouse. This simplifies estate planning somewhat, so you don't have to worry as much about putting assets in each other's names in trust. But the one big takeaway is that nothing is permanent anymore. The tax laws will all expire at the end of 2025 and revert back to the old 2017 rules unless congressional action is taken. With the ballooning debt and the massive stimulus spending due to the COVID-19 crisis, the belief is that tax cuts may not likely get extended past 2025. So in some ways, you could say all taxes are on sale now.
All right, so with that being said, should you think about now is a good time to start gifting money to your family? What I will say is we always say put the oxygen mask on ourselves first and make sure you're feeling very comfortable about your cash flow and your ability to, pay your bills into the future. But once you're in that position where you say, I definitely have what I need to feel comfortable for the rest of my life, and I'm ready to watch my family enjoy some of this money that I have, there's some great, both easy and complex ways to gift the next gen. The bottom two buckets on this slide, that's more for the people that are in the very high net worth ranges that potentially they are worrying about estate taxes, even with these very high exemptions, or they feel that they're ready to prepare for the future when these tax rates might change. I'm not going to dig into a lot of detail on these items, but for example, on the multi-generational trust planning, we're talking about spousal access trusts, GRATs, QPERTs. These are gifting techniques that you can utilize to get money and appreciation to the next generation. We could do a whole presentation on this, and I'm happy to chat with anybody about questions that they have on either this or life insurance trusts. But I want to focus more on these top two buckets because they're the low-hanging fruit and they're a great place to start with family giving. First of all, I think Pete and I have both mentioned at various points that there is an annual gifting exclusion that you can give up to $15,000 per person per year without having any consideration for gift tax. And so this is a great way to, as Pete mentioned earlier, you can use it to front load 529 plans. You can use it to provide gifts to your children. Let's just say they're working on a renovation project or have something they're trying to accomplish, as long as you as a couple are giving less than $30,000 or you as an individual are giving less than 15 or less, you can do this tax-free. So annual gifting, great low-hanging fruit way to give to the next gen. Another really wonderful opportunity, especially in an environment like this, is to utilize intra-family loans with promissory notes and or loan forgiveness. AFR rates are absolutely ridiculously low. You may not even want to lend to your kids for this cheap, it's so low. Short-term rate right now in July is 0.18%. Midterm rate in July is 0.45%, and the long-term rate is 1.17%. And depending on how long you loan the money or loan the money and forgive, that hinges on what rate you will use. So any period 3 years or under is the short-term rate. Between the 3 and 9 year period, it's that midterm rate, and any borrowing for more than 9 years, it's that long-term rate. But I mean, you can see when you hear these rates, this is absolutely ridiculously low, and you can actually create, and you want to document, a very official promissory situation where you've lent money to your children at these rates. You calculate interest at the acceptable AFR rate. And then if you choose over time to use your annual gifting exclusion to forgive some of that borrowing or all of that borrowing, you can do it. And boy, I have seen, even before interest rates got as low as they are right now, I have seen so many families help their children with their first home purchase, with, you know, some big goal like a, you know, education spending or something they're trying to do, and the parents have really gotten to watch and enjoy them spend that money and do it for a very low cost. So utilizing the intra-family borrowing, it's an absolutely great way to get money to the next gen. So with that, we will go to the next slide.
Okay. All right, I'm sure a number of you have a passion for certain charitable causes. And the good news is it can minimize your taxes too. Appreciated stock is a powerful tool for charitable gifting that is often overlooked. You know, some rules apply depending on how long the stock is held. If the stock has been owned less than a year, the deduction is limited to what you paid for it. Stock held over a year can be deducted at its current fair market value. Now, the deduction is limited to 30% of your adjusted gross income. So if you make $100,000 and you wanted to donate 40,000 of stock, only 30,000 would be able to be deducted in the current year, but the $10,000 excess can be carried over for the next 5 years. And I should note on the slide that cash is limited to 60% of AGI. However, under the CARES Act, another new rule for 2020 is that it has been increased to 100%. If a stock has lost value, it is better to sell it first than give it to the cash to the charity. You'll still be able to take a charitable donation if you itemize, but you'll also be able to take a capital loss on the sale of the investment. Now let's do a quick example of the tax benefits. An individual, assuming in the highest marginal tax bracket, donates stock that was purchased for $5,000. It is now worth $10,000. So donating would result in a federal tax savings of $3,700 on the charitable deduction, which would be $10,000 of the fair market value at 30% or 37% rate. Plus, you'd get another $1,000 savings on the 20% capital gain taxes you would have had to pay on the $5,000 gain. So in this simple example, you have almost gotten back in tax savings, $4,700 in total, the $3,700 plus $1,000, against what you originally paid for the stock of $5,000. It is truly a win-win for both you and the charity because they can immediately sell the position for cash with no consequences. And if you did this strategy for 10 years, you could save nearly $50,000, which brings us to our final polling question. Have you ever donated appreciated stock? Okay, let's give it a few more seconds and we'll close the poll. Wow,
Lots of opportunity. Woohoo!
but still a third of you have done it. So that's great. If you answered yes, give yourself 50,000 Fairport bucks.
And if you answered no, remember what Pete told you, because wow, what a great way to help a charity and to save some taxes. All right, so I think this might be our last technical slide, and we're just going to really quickly talk about some charitable giving strategies. Again, towards the bottom there's some very unique structures that you can use to benefit charities, family foundations, CRATs, CLATs, and we see them quite a bit. Certainly ask any questions if you have them, but really I wanted to focus the attention on the donor advised fund. That, again, low-hanging fruit, easy way to maximize charitable giving and to be very strategic in the way that you provide the money. So with a donor advised fund, you can receive a deduction when you grant to that donor advised fund and then distribute the money to the charities over a period of years. So the beauty of that is, let's just say for argument's sake, you have a liquidity event, you're retiring, you're getting a big retirement payout, and you're going to be in the highest tax bracket. Well, number one, yay you maximized your executive compensation. But number two, well, now how do I save some taxes? And as Pete mentioned earlier, there's a lot of tax deductions have gone by the wayside, but the one that has held firm, and thank goodness for that, for so many reasons, is charitable contributions. And so in that year, to offset the really high compensation year, you could choose to make a very large donation, ideally, going back to Pete's last slide, of highly appreciated stock into a donor advised fund. And let's just say for argument's sake, you donated $200,000 in 1 year. You may not be ready to distribute all of that $200,000 in any one given year, but the beauty is you can hold it in that family donor advised fund, and you, along with your children and anybody else who you want to help you to make the decision, can then decide, how are we going to impact the charities and the causes that are most important to us over a period of years? And you can distribute that money out of the donor advised fund over time. Easy to set up, Fidelity, Cleveland Foundation, Charles Schwab and Company, you name it. It's a very straightforward vehicle to use to be strategic in your charitable giving. And it really is a great tool. Pete, is there anything you want to add there?
No, absolutely. And these are only going to become popular under the new tax laws because charitable giving is still available. And one thing I should note that I forgot to mention on the last slide, when you give appreciated stock or any gift greater than $250, you're required to get these charitable acknowledgement letters, which we all know what a pain they can be to track down. And so if you're giving multiple stock to different organizations, you have to get one for every organization. Whereas the beauty also with the donor advised fund that Emily just talked about is you make one gift to the donor advised fund, they automatically generate a charitable letter for your taxes, and you can disperse that to as many charities you want, and you don't have to worry about any reporting after that.
Such a great point, Pete. Thanks for including that. All right, Annika, I think we're ready to move to the next slide. All right, so we are done, and we'd love to answer questions for you. And I was told back when I started presenting, and whenever that was, junior high, I think, that I'm supposed to tell them what you're going to tell them, tell them what you told them. So we're telling you what we told you, and today we really hope that you learned how to optimize wealth at every stage of your life cycle and or the life cycles of your family members if you've passed some of these. As you've seen, the savings can really add up. I hope you all counted your Luma bucks, and we're here to help. There are a lot of things we talked about today, a lot of questions we can try to answer right now. But again, just reach out if you have any other questions for us or you want to dig deeper on any of these topics. Annika, is it time for us to count Luma bucks or answer questions?
We do have a couple questions if you want to go ahead and take care of those.
Great, let's do that.
All right. They are both from Dr. Arndt again.
Oh, Dr. Arndt, you're so good for questions. Bring them on.
All right. He asks, will either of you explain what a $15,000 per person per year gifting program looks like? Do you, out of the kindness of your heart, gift money to your children, or do you do the gifting with caveats? How do you communicate the gifting to your family? I'm preparing to do a Willing Wisdom family meeting with our kids sometime this year.
You want to take that? You want me to take
Go ahead,
that?
Ann, you start.
All right. Okay, so a $15,000 a year gift program actually can look a lot of different ways in its simplest form, and I implement it in its simplest form. There are folks that just say, I would like to give $15,000 a year consistently in cash every year to help my children, grandchildren, whomever it is, build a nest egg, fund projects, whatever it is that they are trying to accomplish. I've also seen it though in a bit more of a complex form where we've used some of this intra-family gifting because there's much larger goals. A child wanted to start a business. A child, again, purchased a large home, maybe did both at the same time. And the parent gave a really significant low interest rate loan to that child. In that case, in some instances, we actually use that child's $15,000 a year to forgive some of that loan as opposed to provide more cash. And so it brings down that loan balance and kind of gets them back to right over time. So I think you can employ it as you choose. In some cases, clients feel nervous and they think, well, if I start this and I'm not feeling so good about my finances, I don't want to set a precedent. I want to be able to stop it. So communication is key in these situations on how you handle this, communicating it to the children. And it's different. It's just based on what you're trying to accomplish. But I do talk to some folks who say, I don't want the kids to rely on it. And so we handle it in such a way that it's a beautiful one-time gift, and we may or may not do this next year. And we do, in a disciplined way, look at the portfolios every year and make sure that we feel comfortable sustaining this continued gift plan. And then we decide yes or no, we are or are not going to do this looking into the future. I thus far have not had any instances where families have ever looked a gift horse in the mouth. The children are so grateful and happy to receive the money when they do. And in years like this, when it is volatile, they don't even necessarily expect that it's going to come. So I think, again, going back to just communicating the right messages around it and what's most important, I think it's always gone swimmingly well in the cases where I've been a part of it. So Pete, do you have anything you want to add?
Yeah, and I would just say, and one of the tools, like you mentioned with the demand notes, is we do use like a demand promissory note that gives you flexibility. So if you're not sure, with a certain child or your gifting strategy, you can always have them pay back if you want to, or forgive it. So that's the beauty of it. It's kind of open-ended, and you can determine your own gifting program on a year-by-year basis with the exclusion amounts to get cash or even stock to kids and for all your children. So it does help also equalize your children too. If you've given one child something differently, maybe property and another one cash, it's very flexible, as I would say, as part of the overall gifting plan.
And then Dr. Arndt, I think you asked the question about strings. I've never actually had to put strings on it, but what's interesting is I've found, and oftentimes I'm dealing with kids directly, they want to tell me what they're excited to use it for. So if they're telling me, I know they're excited to tell their parents what they're using it for. So I do think that, you know, part of this is, again, in how you message it and communicate it. You know, they're gonna want to share their joy with you on what they're excited to use your gift for.
All right.
Anything else for us?
Yeah, before the next question, if everyone has been keeping track of their Fairport bucks, if you want to type how many you accumulated into the chat, we will send whoever got the most a little surprise. All right, and the last question, also from Dr. Arndt, specifically for Emily. Emily, do I understand that my bride and I could be the bank for our daughters for their homes using the intra-family loan process?
Yes, indeed you do. We've done it many, many times before, and I think it's an incredibly powerful tool. And in this interest rate environment, it's just a slam dunk if you've got availability and they have you know, something meaningful that they're trying to accomplish that you want to help them with. To Pete's earlier point, it's really important that you structure it properly, that you document it properly. There's some tax reporting associated with it that you want to keep up with. Simple. Don't let that turn you off, because it's really simple. But you just want to make sure that you're structuring it in such a way that it is truly viewed as the arm's length type transaction that you're trying to accomplish. You may have an eye on some day forgiving some or all of it, but as you set it up like it is a true borrowing circumstance. And so amortization schedules, demand notes, and reporting of the interest that is earned are key. Another thing I think is important is showing some sort of a payback cadence on the part of the family member you're lending to. Even if it's small amounts, you know, we have a circumstance where someone had borrowed for starting a business. And of course, that's a huge amount of money that you have to borrow to do that. And even though we spread that loan out over a 30-year period, it was still a daunting amount monthly for a younger child of a client to pay. And so over time, we showed a payment cadence, and then we peppered in that annual gifting loan forgiveness to try to whittle that balance back and show a meaningful step towards getting that paid back. That, I think, is really key. You need to demonstrate that you truly are using this as a lending mechanism. So there's ways to do that. But yes, indeed, you can be the bank. Pete, do you want to add anything?
Yeah, and I don't think any bank interest rate would be lower than what these IRS rates are.
No, I'm looking at refis right now, and they're low, but they're not that low.
And it's a small price to pay to pick up a few dollars in interest in order to be able to gift your kids enough to put a down payment on a house, or maybe a wedding, or buy a new car. It's really an opportune time to take advantage of these kind of strategies.
It really is, and it creates cool conversation and engagement amongst families too. There's, you know, some real beauty to doing this. Do we have anything else, Annika?
I don't have any more questions.
All right, so here, let me just do one commercial for you. If you liked this, then we've got another couple of programs coming up for you. On July 23rd, our Wealth and Wellness series continues. We have Fuel Your Health with Marie Zeman, and she's going to talk about more taking care of your body than your mind. And then we have another financial wellness installment coming up on, I think it's August 13th. I'm doing the program, so I should know that date. And that's my colleague Katie Sheehan and I, focused on wealth accumulation. We'd love to have you join us for our programs. We're so happy you were here today, and we welcome any questions. Just reach out and give us a call if you want to chat any further about what Pete and I have talked to you about today.
Well, thanks everybody for joining us today.
Have a great day, everyone.